Welcome to the Ned Group Investments quarterly briefing, where we profile some of the interesting takeouts from our recent fund manager workshop with our local best-of-breed managers. To hear the full fund manager presentations or for more information about our funds, visit the Ned Group Investments website or access more of our content via LinkedIn, YouTube, or our podcast channel. In this episode, we look back on the whirlwind year that was 2024. We discuss the year of elections, where we saw Trump being re-elected and South Africa getting a renewed sense of hope with our government of national unity. The start of the US and SA rate cutting cycle, with numerous expectation recalibrations as US inflation remains sticky. And notably, a US equity market which defied all Wall Street expectations. Lara Delmeyer, who co-manages the Ned Group Investments Flexible Income Fund, explores the persistent challenge of controlling inflation in the US economy, despite the implementation of tight monetary policies, and emphasizes the role of fiscal dominance as a key factor driving sustained inflation.
So why do we say the US economy is in a period of fiscal dominance? We say that because it's become very clear that these big structural deficits in the US are surpassing private sector lending or monetary policy as a tool for economic activity and inflation. So to fight fiscal dominance with monetary policy, we believe likely will continue to be unsuccessful. That is why, despite being, interest rates being very high, you are seeing economic indicators like the non-farm payroll continue to print very high numbers. Just to give you an indication, we believe that in order to see some kind of rollover, you need to be seeing prints of about 100,000 to 150,000. The last print was still over 250,000. So we expect that to continue, and we therefore expect inflation to struggle to move lower. As you mentioned, Trump, although he certainly didn't invent fiscal dominance, we think fiscal dominance would have been a theme regardless of which party came into play. He does, however, exacerbate that. Deficits under Trump, we believe, look to be higher, despite what they're going to try and do through the Department of Government Efficiency. And his policies by nature seem to be more inflationary, whether these are once-off inflationary shocks or longer, what the size of those will be. Unfortunately, the market's also treading on eggshells a bit because we aren't really sure what to expect. But in general, we do expect it very hard for the US economy to taper and for inflation to taper under current conditions.
Lara also discusses why it is important for the South African Reserve Bank to consider global interest rate dynamics, particularly in the US, when making monetary policy decisions.
You can see that rate cut expectations have moderated here quite significantly as well. And interestingly, the market thinks that it's only got one more cut priced for the rest of the cycle. So that is very low. The market thinks one more 25 basis points and the SARB may have to stop. And that is absolutely 100% attributed to what is going on in US monetary policy. We agree with the market's concern. Whether it is only one more, we can't be 100% sure, but we agree with the market's concern that SARB can't move if the Fed doesn't move. That interest rate differential, in our opinion, is just not high enough for us to move to any considerable degree if global base rates remain high. And the reason for that is we need to compensate investors for investing in South Africa. We are a higher risk nation with higher risk instruments. So obviously you do have to offer them that risk premium. And if that risk premium is not there to a substantial degree, that threatens local assets. It threatens the rand, it threatens local markets, and naturally that feeds through into inflation. So the SARB, unfortunately, has its hands tied if global rates, particularly now the US, does not move rates lower substantially. So it is a difficult conundrum for the SARB because, as you mentioned, our inflation isn't problematic. As a matter of fact, they themselves don't see inflation reaching the midpoint of the target band this year. And, if you look at a variety of other estimates, the majority of estimates don't have inflation reaching the midpoint of the target band for most of the year, perhaps potentially only towards the end of the year. So from that point of view, you would think they do have room to cut. But I think global rates are unfortunately driving that narrative.
Rashad Tayyib, a portfolio manager on the Ned Group Investment Stable Fund, discusses the unusual reaction of the US bond market to the Federal Reserve's rate-cutting cycle and the growing concerns about the sustainability of current spending levels.
I think unfortunately, the governments around the world, and especially the US, got into this habit of overspending during COVID massively, and they're just struggling to break that habit. And I think the second half of last year was when you saw the first signs that the bond market is beginning to get a bit upset about the amount of spending and the lack of constraint. If I look back at the history of the US, there's always been politicians concerned about the deficit, about they've got that debt clock in Times Square. So it's always been an issue about big government. But we think on both sides, whether you're Republican or Democrat now, they're both into this habit and they just want to spend as much as possible and juice the economy. So that is a concern. And when you look at the chart here shows the reaction of the US 10-year bond after the rate cutting cycle started in the middle of the year. And generally, when you see the Fed beginning to start cut rates and the beginning of the cycle, it's a great time to buy bonds because that's when the rally starts and it continues as you enter a rate cutting cycle. But this time, bonds actually sold off after the Fed started cutting rates. And that is a very strange phenomenon. And a lot of that is due to the fact that I think there's a lot of concern around the market, how sustainable this level of spending is and how much supply of bonds that are going into the market. So we do think that there are signs building that the market is struggling to digest this US debt problem.
Rashad also highlights the challenges facing Trump in replicating the growth success of his first term due to different economic circumstances.
I think it's going to be quite difficult for Trump to replicate the growth success of his first term. We know in terms of his personality, how he runs his property companies, his businesses. It's all about borrowing money, juicing growth, getting a lot of hype going. And he was successful in his first term, but the circumstances now are quite different. If you look at where the S&P 500 is, was sitting around 2,000. It's now close to 6,000. Look at where the average house prices were in his first term. They're now more than doubled. So asset prices have already been moved up a lot. If you look at what he did on taxes in order to boost growth, you see he took down the corporate tax rate from 35 down to 21%. The marginal tax rate came down a bit. He's now talking about taking corporate tax rates from 21 to 15, which would be amongst the lowest in the world. I don't know whether he's going to get that through. And we already talked about the deficit problem. So to cut taxes from here is going to be quite difficult. He's also inheriting the spending problem where last time he took over, the deficit was only 3%. He then pushed that higher by trying to spend a lot. He's now taking it over with a 6 to 7% deficit. How much more can he really borrow and spend? So the circumstances and the hand that he's been dealt now is quite different. He can't necessarily run the same playbook. And I think that's why you're seeing him run you're seeing this big focus on tariffs. And that's where China, Mexico, and even Canada are getting roped in terms of being a problem for the US economy because he sees that as a way to raise money to fund this deficit and also get more of the growth back into the country. So you're seeing a realization that maybe he can't run the same playbook and maybe the growth boost that we saw in the first Trump term is not necessarily going to be replicated.
Omri Thomas, who manages the Ned Group Investments Opportunity Fund, shares the positive prospects for the Chinese market, highlighting its resilience and attractiveness despite geopolitical tensions with the US.
I mean, it's interesting. Everyone's quite negative on China, but if you look at the Chinese market, last year it didn't actually perform that badly. I think it was the second best performing market after the US. So it didn't feel like it because it felt like China still did badly. But remember, there was quite a strong rally sort of in the second half of last year. It beat it out a bit, but despite that, Chinese shares still look extremely attractive. If you look at the Chinese index, the MSCI China versus the MSCI All Country World Index, it's still at a multi-year low. And I mean, it's back to its levels where it was sort of the start of the century. Now, if you look at China, they've got a trade surplus of $1 trillion a year. So I'm going to think of a company when a company's got such strong cash flows. What do they do with it? They can do share buybacks. And to some extent, that is what you see in China at the macro level. The Chinese is doing a lot of fiscal stimulus by pushing that money back into the market. So they've been cautious on not overdoing it and creating bubbles. But at the same time, you've got the companies who's also cash flush. And they've now started buying back shares. And that's at valuations 70, 80% lower they were previously. So China's still growing. I think if you're willing to see through the short-term geopolitical tension between China and the US, you could be picking up shares giving you multiple returns from current levels at very attractive valuations.
Junaid Bray, co-portfolio manager of the Ned Group Investments SA Equity Fund, notes the positive sentiment surrounding the South African election results and discusses whether there's any concrete evidence of economic change to support this optimism.
The sentiment is there, but have we actually seen anything? So I think, look, the first major one is, I think, load shedding. I think since March last year, we haven't seen load shedding. And I think that in itself is quite a big driver of sustainable growth going forward. And I think we were all skeptical around election time, whether they were keeping, burning more diesel just to keep the lights on. But we're sitting here comfortably with almost a year without any load shedding. So that's great. I think you have seen a lot more interaction and engagement between government and the private sector, something that we were lacking for the last 10 years. And that's come through quite nicely. So I think what needs to happen is a lot more infrastructure investment, because I think we've got a serious infrastructure deficit from what's run down in the last 10, 20 years. So there's a lot of catching up to do. And I think we're starting to see signs on the logistics side. It's not going to be a short-term turnaround, but I think in the next 3 to 5 years, you're going to see significant improvements in logistics. I think water infrastructure, I think especially those living inland, water is becoming a big problem. And I think we need a lot of spend there. And I think there are engagements happening to start getting that spend off the ground. And I think, look, some departments, like I think the Department of Home Affairs, I think the Minister's doing great work there in improving the efficiency, getting visas for skilled labour and workers coming back into the country. Those sorts of things, I think we are seeing signs of that happening. But I think when you put all of that together, I think there are upside risks to expectations.
Junaid also highlights the potential economic benefits of sustaining momentum with economic reforms and increased consumer confidence.
So I think we've come through a period now where we've grown, our economic growth has been so slow for the last 10 years that even when we look forward, I think economists are hesitant to put anything north of 2%. It looks like about 1.7% for this year and maybe 2% for the following year is what is penciled in. I think when we chat to policymakers, Treasury, etc., I think they're earmarking 3%. Now, I think, look, that's quite optimistic, but I think anything north of 2 is well within reach, 2.5. And that's why I think there's quite a lot of upside to economic growth. Now, I think with that comes the multiplier effect of job creation, and a lot of the infrastructure investments does create a lot of jobs as that process gets rolled out. So I think job creation is one thing. And I think, look, where we are cyclically at the moment, I think you will see the benefit of lower interest rates for the consumer, as well as the two-pot withdrawals, I think will be a bit of a short-term feel-good factor and spend factor for some of the retailers.
Saul Miller, co-portfolio manager of the Ned Group Investments Balanced Fund, explains how inflation and high deficits in the US are impacting US bond valuations and where this leaves the asset class relative to other investment opportunities.
We've got very high deficits in the US. They're over 6%. They double what they've historically been. You've got this continual trajectory of rising debt levels. Hasn't been a problem. We've still got a strong dollar. We still have bond rates that are reasonable. So markets aren't worried. But at some stage, that becomes a problem, and you're going to have to rein in that spending. I mean, at least back to some kind of average level of, say, closer to 3%. So that is a medium to long-term headwind. You've got consumers that are not saving very much. Consumption is at a fairly high level. It's certainly at a higher level than it was pre-COVID. So good consumer confidence and a lot of spending. You've got these high bases, high earnings levels. That is all going to have to come down, I would think, at some stage. So we've certainly been completely wrong in expecting a recession, which never happened. But we still think the risk of a slowdown is there. And when that happens, that would obviously bring bond rates down. So it's not sort of clear that bonds are trading in an area that's unreasonable. They don't look especially cheap or especially expensive. We have fairly low conviction around where bonds would go from here. So we're not taking much bond duration at all, particularly in the US. We'd rather be in the shorter part of the curve, and we'd rather have a bit of credit. As in, we just don't have a lot of comfort on either direction for US bonds. For US markets, which obviously get affected by US bonds, we also think that they are reasonably expensive. Now, you're going to need a recession to probably bring those markets down. Markets don't just come down because valuations are high. So it doesn't look like that's happening in the short term, but over a more long-term view, we do worry about those valuations. We think there is better value out there. There's good value in SA, as I mentioned earlier, given the changes that we're seeing politically here. And there is some good value in the rest of the world. If we look at Europe is obviously struggling at the moment. But there's some low bases in Europe. There's obviously very low consumer spend. They're in a manufacturing recession. We're having some major political upheavals in Europe. We could see some changes, for instance, in the German government. You could actually have some government stimulus coming from there. So you could actually get a bit of an improvement in Europe over the next year, even though things look a little bit tough at the moment, and valuations are quite reasonable. We're seeing reasonable valuations in a number of sectors, whether it's the banking side in Europe or defense, which is obviously a theme that benefits from these heightened geopolitical risks and countries being more focused internally. So, there's some things that should do well. Net, it's not great for economic growth, but certain industries could benefit. So those would be some of the areas where we would be seeing value and where we would be positioning. But certainly not in long duration US bonds. That feels a bit like a coin toss at the moment.
Walter Eilert, Portfolio Manager of the Ned Group Investments Bravata Worldwide Flexible Fund, reflects on previous periods of high inflation and high interest rates and expresses caution about the current economic environment.
I always try and think very long term. And if I go back to the 70s, which feels like where we're going now, high inflation, high interest rates, politics is terrible, Iron Curtain's going up, Chinese bamboo curtains going up, and there's this tariffs and regional conflict. We had a wonderful time when the opposite happened in the 80s and 90s. And we've benefited since 82 of declining interest rates, which is great for property investors, equity investors. And at the moment, it feels like that's all changing. It's been changing for quite a while. And if you think longer term, it's quite difficult to be quite optimistic on asset price. I think we've been spoiled. And we need to have a washing out process. And if you look, we've invested in Greece many, many years ago, and it's amazing. Their bond rates now are lower than the French bond rates. And you need that washing out process to happen, and we haven't seen it happen yet. We saw a bit in Brexit with the UK, but the US needs a reminder that there is a cost to money, and that's what concerns me. And then I do think that all this hype around AI just reminds me of Y2K. And it might come back where it's actually just a great tool like spreadsheets and not necessarily going to take over the world. But robotics will come, people will lose jobs, productivity will go up. I don't know. We're just cautious. I think you've got to buy what you know and be predictable. And then I do think there's some very smart people that are reducing their equity exposure. And I don't think they're great timers on the market. They're not trying to do that. But I think it is significant that people like Warren Buffett, where he's reduced most of his Apple stake. There are a few others. We'll have to wait to see what they do with their cash because they've also sold a lot. We're just trying to just chip away and find good assets and do nothing if there's nothing to do. Let Mr. Market serve you.
Thank you for listening to the Ned Group Investments Quarterly Briefing. You can access more information about all the fund manager workshops at the Ned Group Investments website, YouTube, or through our podcast channels on all major platforms. Please join us for our next edition at the end of April 2025.